Hello, everyone, and welcome to your Glassnode video report for week 46, 2023. So, as I mentioned in last episode, we're going to be continuing with this concept of supply dynamics, and we're going to be using the halving as our reference point, more so because it's coming up, and it obviously represents a point of keen interest for investors. So what we're really going to be looking at here is using a number of supply metrics, different heuristics, different ways to measure the Bitcoin supply. And we're really looking for that confluence. When do we see multiple metrics telling us a similar story, which obviously builds up conviction and confidence that we're starting to get close to some semblance of truth. So with the fourth Bitcoin halving fast approaching, it's expected to be in April 2024. Now, the reason why this is an important area for investors, we will look at the return profile that typically happens following halving events, and it is in excess of 400%. Now, of course, this doesn't mean that that's what's going to happen in 2024, but it's certainly one of those things with the few data points that we have, it's obviously a point for investor intrigue. Now, rather than just saying, okay, the price went up 400% in previous cycles, what we're actually going to do is explore the investor dynamics that underpin those previous halvings. In many ways, looking at the realities on the ground on what really drives, at least in part, what is going on, what is behind that price performance, rather than just saying halving happens, price goes up. We're going to actually look at the supply dynamics that are an underpinning driving factor. So we're going to do this in a couple of different steps. It's really building on the report we did last week. We're going to start by measuring what we're going to call available supply that's kind of freely circulating that investors today can reasonably expect to change hands in the near term. We're then going to compare the rates of saving or the inverse metrics of HODLed or stored or saved supply. And we're going to use Issuance as our baseline simply because it's a nice way to just frame things up and normalize things, right? If we're comparing the amount of saving relative to Issuance, it's a nice grounding anchor that obviously compares between these halving cycles. And the last thing we're going to close on is a topic that we actually covered in our realized cap video that we released a couple of months back, really looking at the kind of the multiplier effect of different periods of liquidity. And we'll explore that when we get there. So as always, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. And let's get stuck right into the analysis. Okay, so here we are starting in our week 46 dashboard, and we're going to start just with a very, very simple metric. Shows you a really cool workbench construction that we worked on to actually calculate how many days until the halving. So within this particular function, we actually input the block interval because mining is a probabilistic event. We don't actually know there's going to be 144 blocks mined on any particular day. It fluctuates with hash rate. It fluctuates with probability. It's not a uniform metric. So as a result, the actual number of days that we would estimate when that halving event is, there is no way. We know the block height when it will happen, but we cannot estimate the exact date and time. What we really need to do is look at it in terms of probability distribution. So I won't go into the details of this workbench, but what you can see is we've actually set up a function that will reset at the point of the halving and then go back to recomputing. So it's one of these interesting workbenches where we have a bit of a reset function that's looking for the time when we hit a specific block height, which in this instance is going to be every 210,000 blocks, reset back to 0, and then start counting down again, taking into account the variability of actual block timing. So that's a bit of a workbench. Now, for those who are not familiar, the magnifying glass in the top right of any chart in a dashboard will expand either the workbench or the dashboard. So that kind of gets you into the mix, and you can see how we've built the formulas to construct these types of charts. Okay, so starting up with the actual analysis of the piece, I mentioned at the start that generally speaking, we get pretty impressive price performance following the prior halvings, keeping in mind that this is only 3 data points, right? So we are in the process of approaching that 4th data point, and of course, we will see what happens from there on. So this particular chart, again, is leveraging our workbench function. We're using the subset, which basically takes the first 365 days following a halving event and then indexes it so we can see the indexed price performance. Now, in previous cycles, we've got up to 400, 600, and in the early cycles, which I think are a little bit too old to be directly comparable, it was getting up into the several thousands of percent increases. But obviously this chart, at the very least, is why the halving creates a lot of intrigue for investors. So not only is the halving a technical and, in some ways a philosophical marvel of Bitcoin, it's really fascinatingly simple and elegant concept. for investors, it's obviously a point of intrigue. Now, as I said, we're really going to explore the mechanics of what drives this from a investor performance, rather than just looking and saying, oh, look, number go up. We're going to try and dive into the mechanics of what's going on under the surface. So to just put some numbers on the rate of issuance that's currently coming into the market, the blue curve here is looking at the USD issued to miners. So this is basically the USD reward, not including fees, only the block reward, new issuance. Now, just to put things into perspective, the blue curve is the USD curve. The purple line here is the current year-to-date high. It's approximately $1 billion a month that's coming out to miners. So most miners have to sell all of the coins that they mine. So just at a high level, that's $1 billion headwind per month in order to keep the Bitcoin price stable. That's just, just very, very high level, all things are equal. Now, if we were to halve that, that obviously goes down to $500 million or 500 million. And this compares to the 450 million per month at the FTX lows. So obviously, given Bitcoin is up, just over 100%, the halving essentially takes us back down to these cycle lows. So just putting it a bit of perspective, we're talking about $500,000 a month in sell side pressure. That's essentially going to be alleviated from the market. So that's obviously the first part of this equation, but just put some dollar numbers just for those who want to some quick back of the envelope mathematics on the impact of the halving from that perspective. Okay, so really getting into the meat of this episode. Here we're looking at available supply. So as part one, we're going to look at how many coins can investors reasonably expect to transact, change hands. That's what we're going to classify as available. And there's a few different heuristics we can use here. So obviously the orange curve here is our circulating supply, which is up at 15.5 million. Down here, this top surface of the red curve is what we call short-term holder supply. Now, we'll use this as our top surface here, kind of the maximum amount of coins that we can expect to change hands. These are coins that are not on exchanges. So long and short-term plus exchanges equals circulating. So this is exclusive of exchanges. We have different other measurements called what we call hot supply or warm supply. These are coins that transact in the last 1 month or 1 week. And in the purple we actually have down here is the open interest in futures markets. There's also a trading volume there as well. There's a number of different ways we can measure and which ones we can overlap and double count and which ones are actually exclusive. But the concept that I really want you to take away here is on any particular period of time, between 5 and 10% of the total Bitcoin circulating supply is either futures open interest or coins that moved in the last 1 month. So we're kind of talking about, in terms of coins that really move around on a weekly basis, it's about 5 to 10% of the circulating supply in kind of equivalent size. So we're really talking about 90 to 95% of the circulating supply is dormant, and it really isn't participating week to week. It's that 5 to 10% that's really moving around. So we're starting to zoom in and actually narrow down what's available. And again, a lot of this is just about putting things into perspective. Now, if we look at things in terms of balances on exchanges, now this is a chart that gets circulated quite often, and I would strongly encourage everybody to actually jump across to the report for this particular week, because we actually explore not only exchange balances in there, but also some of our estimated calculations for and balances for Coinbase, including Coinbase custody and the GBTC. So these are more of these heuristics that we're working on in the background here at Glassnode. Now, what I really want to highlight, because obviously exchange balances are an obvious source for coins that are likely to change hands. They are quite literally one red button away from being sold and purchased by somebody else. Now, a really important note, and one that's been widely documented, is this turning point in March 2020. Really, the market went from a net uptick in overall balances on exchanges to a net downtick. Now, as I mentioned before, and I strongly recommend people check out the report this week, a lot of this is actually due to both investors really acquiring and pulling coins off exchanges. That is most certainly part of the equation. But we also saw an explosion in products like collaborative custody, Coinbase custody, the GBTC product. All of these things which really do represent a demand level, but often from institutional level clients. These are talking about large scale custodial relationships. It's not really the same, buy and withdraw. This is a different cohort of investors who really entered the Bitcoin market around 2020 and onwards. And we are talking about a different audience who expresses their data regarding their custody is actually expressed differently to what you would otherwise look at for other investors. So again, I would encourage you to check that out. And what I'm just going to jump across and look at is another heuristic that we developed, which was our liquid and our highly liquid supply. And what you can see is that the shape of this pattern is very similar to our exchange balances. And that's because quite often exchanges are liquid and highly liquid balances. So what do I mean when I say liquid and highly liquid? Well, the heuristic that we developed here, there's a number of different ways we can measure supply. In the previous one, we were looking at available supply, short-term holders, 1 week, 1 month. That uses holding time as the heuristic. How long has it been since a coin last transacted? The reason we do that is that when a coin transacts, it is highly likely to transact again. This is kind of probability that the more a coin is dormant, the more likely it is to stay dormant. For liquid and highly liquid, this is a different framework. This is how often that particular entity spends. So if you're an exchange, you have lots of deposits, lots of inflows, and lots of outflows. So your spending behavior is quite liquid. The other side of that equation is the illiquid supply, where coins pull out of an exchange into an investor's wallet and they stay there. That's what we would classify as illiquid. So that particular entity doesn't spend a lot, but they do receive. An exchange, which is why we have a very, very similar pattern with March 2020 being that pivot point, we saw more coins flowing out of highly liquid and liquid wallets, which by default means that they're heading towards illiquid wallets. So what we are seeing is a dramatic uptick in our illiquid wallets over time. Now, what you can also see is that illiquid wallets represent the vast majority of the Bitcoin supply. So again, it makes it one of these interesting elements, but the right way to think about this, it's kind of the inverse of those exchange type products. When you see coins going into some kind of custody solution, for example, yes, they may be held by Coinbase, but they are still owned. In terms of their ownership arrangement, some entity, be it an institutional or a GBTC or an ETF or whatever it is essentially the owner of those coins held at a custodian. So again, it's why we use multiple heuristics to try and look for patterns that really match across the board. So what I really want to highlight, just closing out this section on available supply, what we've plotted here is exchange balances in orange, short-term holder supply stacked on top of that because they do not overlap. We're talking about two separate groups here. And then we also have this curve in the middle here is the percent of circulating. So let's sum those two together. Short-term plus exchange balances, both of them are about 2.3 million Bitcoin, so they're actually equivalent in size. Take both of those volumes, divide it by the circulating. We are at all-time lows relative to circulating of 24%. So we really have the smallest amount of all Bitcoin in really the history of measurement. And again, this comes back to how we're measuring our different heuristics. And we're not looking for the precise number here. We're looking for what is the general trend and the shape and where we're at. Based on all those heuristics, to the best of our estimate, 24% of the circulating supply is a reasonable estimate for how much can reasonably be expected to transact. And remember that on a weekly basis, we're talking about 5 to 10% that is usually moving. That's kind of your base load. So we really have a very, very small amount of, in inverted commas, available supply just by these different metrics. Now let's compare that to the inverse, which is our stored or our saved supply. That's obviously the inverse of the metrics we've just looked at. And what we can see, we've plotted a bunch of these together. Red and orange being the warmer colors are available supply measures, and the cooler colors of greens and blues are saved or stored measures. Now, what we can see is that since really since 2021, we've seen a widening out or an opening up of this divergence. There's a bit of an alligator jaws going on. So I'm just going to zoom in on a 5-year basis to really look at this in a bit more detail. And what we can see is that this divergence is actually getting pretty stark. If we look at things like liquid and highly liquid in orange, it is trending lower. If we look at short-term supply plus exchanges, it is trending lower. If we look at illiquid supply and long-term holder supply, they are both trending higher. And we also have in here vaulted supply, which comes from our coin time economics framework, that is also trending higher. Now, these are all on different axes, so I encourage people to actually jump in here and have a look and test out where these things lie. More for visualization, that's why they've been put on separate axes, just to make it a little bit cleaner to see. But the important thing here is the trend, and these are diverging. We have more coins going into stored, saved, and illiquid wallets, and more coming out of mobile, highly liquid, and exchange type wallets. So moving into part 2 of this episode, we're looking at the rates of that storage. So we're now looking at the saved or the stored side of the equation. So in orange, we've got our month. In this case, we're looking at on 90 days, so quarterly issuance. And we're comparing or overlapping the rate of change of illiquid supply over that 90 days. So the other way to think about this, when coins come out of an exchange, they're leaving a highly liquid and going into an illiquid wallet, right? So they come from a high degree of liquidity, exchange balances and the like, towards what we could otherwise, let's just call it a accumulated or a HODLed or a wallet that has less history of spending. Now, what we can see on the previous halvings, note that the illiquid supply change is substantially higher than it is from, actually from the issuance before the halving, but most certainly on the issuance after the halving. The key point here is this really demonstrates an investor demand profile. People seem to buy and accumulate into and through the halving. And you can actually see that really since February 2021, we've seen significant accumulation that has more than the issuance for pretty much that entire period of time. So we've almost had 18 months, maybe 25 months, 24 months of full-scale accumulation where every single coin that's mined is essentially going into some form of illiquid wallet. So when we have the halving, this is already substantially higher than where we are. And again, this is only one heuristic. We're going to explore this. This is why we look for confluence, because one metric is not going to tell us all the answer. But we can see that investor accumulation patterns have actually been quite substantial, despite the fact that the market went through a significant bear drawdown in 2022. Now, coming across to those time-based heuristics, this is long-term holder supply in the blue and vaulted supply, which is a very, very dense, heavy form. It's kind of the heaviest component of that HODL supply. We can see three interesting waves in all previous cycles, actually. So let's look at 2015. We had our first wave of accumulation following the first sell-off. This is when the bear market has kicked in. The all-time high is now well and truly taken out, and we are some distance below. That first wave of investors, we see it here in 2018, step in and actually buy that. Oh, look, it's no longer 20,000, it's now 6,000. Or it's no longer 13,000, it's now 1,300, it's now 600. It's kind of that first wave of, and we see it here again in 29,000, that first wave of buy side. The second wave typically comes in towards the late stage bear. We see it through 2015, we see it through much of 2019 into 2020, and you could argue we've seen this through most of 2023 that really put in that floor from around mid-2022 when 3 arrows blew up, we got down to 17,000, all the way through to FTX. And the third wave actually comes into and through the halving. We see it here in 2016. We see it here again in 2020 following the COVID event. And obviously it's not just the halving. There's also all the other macroeconomic events. But we are seeing that similar rate of accumulation that is well and truly in excess of issuance, well and truly before the halving. So again, we've got this very, very robust and resilient hodler accumulation at this point in time. And given that issuance is lower and lower, that is why we're seeing available supply reaching these kind of relative lows, because the only other place coins can come from is from existing holders who are actually selling and distributing their coins. So there is quite a bit of buy side coming in by these metrics. Now we can compare this to another metric. I mean, there's different ways we can measure supply. And I think what I really want to highlight here is we can use time, we can use spending heuristics. Here we're using shrimp to fish, so how big the entities are. And we can see that shrimp to fish, right? These are wallets under 100 BTC. They are also accumulating at a rate that is equivalent to issuance. Naturally, there's going to be overlaps between these, but they're different heuristics, different ways we can slice and dice the supply. So you can see that essentially you could argue that in terms of the issuance that's currently being brought online for miners, the shrimp and fish are essentially accumulating all of it. So then we could also look at the other cohorts to get a bit of a full picture. But this is just trying to show how different heuristics can assess this mechanic. And as a nice summary of all these things, this is another way we can use Workbench. I've reset the circulating supply to the 1st of January 2022. So we're looking at basically the last 2 years, not quite 2 years, but close to it. The orange is how much the circulating supply has increased. The green curve here is how much vaulted supply, again, that heaviest, densest form of HODLed coins. It's 1.1 times larger than circulating. So pretty much every coin that's been mined, plus 10%, has gone into that vaulted category. Those fish to shrimp is then getting up to about 1.8 times the circulating. If we go to long-term and illiquid supply, we're getting up to 2.4, 2.5 times the issuance. So it just shows you that we're seeing more than all the issuance mined over that 2-year period is going into one of these forms of storage. So with all that as context, the next thing that we're going to cover is what is the actual impact that this may have on the market. So again, let me just highlight and go back to that report that I mentioned about the realized cap, which we did release both a video and a written report to really explore the realized cap. It's a really, really powerful metric that all analysts in this space should really become quite familiar with. The big highlight is that what generally happens market cycle after market cycle is we see coins that are accumulated during the lows, right? What we see during bear markets, let me just turn off my tooltip here. During bear markets and these big long sideways accumulations that we have, like 2018 through to 2020 and 2015 and 2016, and indeed 2022 and 2023, is the realized cap tends to trade sideways to slightly down. This is because losses dominate, but generally speaking, investors leave the market. There's a lower retention. And what happens is that things become less liquid. We see more price swings, more volatility on small capital inflows and outflows. During bull markets, on the other hand, we see an explosion of profit taking as coins accumulated in the previous cycle are transferred to new investors at higher prices, realizing profits, pushing the realized cap to higher levels, and essentially getting to this point where the market expands. We see capital flowing into the industry. Now, during these periods of capital inflows, as anyone who's been through a Bitcoin bull market probably knows, things can get pretty wild. But ultimately, the bull market comes to an end. That profit taking oversaturates the inflowing demand. And the concept that we're trying to explore here is, given all of the supply dynamics we've just looked at, how can we essentially measure, assess, gauge how much capital inflow or outflow in the realized cap produces a $1 change in the market cap? So another way to think about this, what is the leverage ratio, so to speak? How many dollars have to go in to create a $1 change in the market cap? So I won't go through the full construction of this, but what we're basically looking at is how many dollars does the realized cap change, up or down, to produce a $1 change in the market cap, up or down. This is a non-directional basis. It's really looking at that almost liquidity ratio, the gearing ratio of dollars in equals what out the other side. So the gray curve down the bottom here is that on a 90-day basis, on 90-day median, just really trying to pick the big picture here. We're not looking for overly precise. You could obviously go down to smaller time frames to look at this on a much more precise and granular level. But what I want to highlight, the orange zones here, is when you need more than 75 cents, and at bull market peaks, it's over 80 cents, 85, $1, $1.50. $1.50 needs to go in to produce a $1 change in the market cap. That's when we start to get to fairly overheated, oversaturated, let's call it unsustainable levels. And the converse, during those bear market accumulations, 2018, 2019, 2022, we get down to capital ratios of sometimes less than 10 cents. So 10 cents of capital inflow or outflow creates more than $1 or $1 of market cap change. Now, as I mentioned, this is directionless. So you can see here during the low liquidity periods of 2022, a 10-cent outflow created a $1 drawdown. So that's why you get these really violent sell-offs during those late stage bear markets, because there's just not enough liquidity in there to support the market. And it works in both directions, right? So where we currently are is in one of those periods of relatively low liquidity. This red curve here is the 4-year median, and it's basically traded about 25 cents. So right now, where the market is on a long-term median, 25 cents coming in or out of Bitcoin is creating about a $1 equivalent move in the market cap. And actually, if we look at where we currently are, it's back down towards about 15 cents on the gray curve. So it's just one of those kind of concepts or frameworks you can take away with you to really study how the supply dynamics that we've looked at can then translate across to what's going on with capital change, how many dollars are flowing in or out, but really using the realized cap and merging it with our supply metrics to get a really complete picture. And I think that the story I want you to take away from all this, if we go back up to our halving, to our long-term holder supply, whilst the halving certainly halves the issuance, it's really the investor behavior leading into through the bear market, putting in the floor, and then through the halving itself that actually creates these dynamics. So in many ways, we're describing the investor behavior Now, whether it's a self-fulfilling prophecy that the reason the market goes up is because the halving happens and that brings people in, or whether it's the people who know about the halving that actually put in the floor, buy those levels during the bear market, and then acquire during the halving event itself, that creates that upwards momentum. All of these mechanics, what we're trying to do is describe the investor behavior rather than just saying number go up, putting some actual mechanics and investor dynamics behind the whole thing. So thanks everyone for tuning in for that session. Hopefully you found both this week and last week useful as a kind of overall view of how we can use many different supply metrics, many different heuristics, different ways of measuring supply, and really using the halving as a bit of an excuse to go through and look at this. What really drives the behavior is investors, and what on-chain analytics is really giving us is a lens to actually observing this investor behavior. That, quite frankly, is very, very hard to do in many other assets, if at all. So it gives us a really, really unique lens, and hopefully you enjoy kind of exploring these dynamics from a more fundamental perspective. So until the next one, thanks for tuning in. I'll catch you then. Cheers.